Hello and welcome to Market Watch for the end of the week that started on the 6th of November 2017. All I need to concentrate about this week is all the stuff that's come out of Martin Place. I'll very quickly look at what happened on Melbourne Cup Day. We all know they didn't move rates, not unexpected in any shape or form. And again, the statement certainly led to the idea that they are slightly worried about inflation. They certainly pointed to the fact that wages were going to remain subdued and probably longer than they suspected. And then the other part of it is they really did finger the Fed and China as reasons to sort of possibly see movements in 2018 on an economic front, which brings me to what actually happened at the end of the week and around the statement of monetary policy. Have a look at the chart you've got on screen at the moment, and this is the chart we always look at. This is the outlook statement that they always put out each quarter. They did, and I'll put an admin sort of note in there first, they did move away from the ranges. They used to give you a range of what it's there. They've now taken that away, and so you can see the figures looking at CPI is now coming in at around about 1.75% for 2018, 2019 at 2%, and you can see it goes all the way out, so June and also straight out into December. First conclusion out of that is we are not reaching their band of 2 to 3% in core inflation at all through their current forecast. That therefore means that their ability to probably think about raising rates, which is when you hit the middle of the band at 2.5%, isn't going to happen in the next 2 years. That's a downgrade of 50 basis points from the last read, if you do want to look through it. Headline figures, and you've got those on that chart as well, is down quarter. GDP is also quite interesting in terms of what's going on there as well. So again, looking at the GDP figures for 2018, 3.25%, that's basically a little bit lower, it's 25 basis off. And if you look at June, it goes up to as high as 3.5%, but then back at the back end of 2019 for December to 3.25%. All those are slightly weaker. Do also highlight the employment numbers. They are quite strong. Have a look at those at 5.5% all the way through to pretty much to the back end of 2019. It is slightly lower at the back end. But in saying that, what they do very much outline in that statement is that having a look at the rest of the world, even with the idea that you are seeing stronger job creation and stronger growth, we know that the time for that to translate through to wages and through to inflation is taking much, much longer than they expected. The next conclusion of that is that clearly they're saying that actually wage growth could be a material downside, despite the fact that we're seeing employment improving through that period for quite a longer period of time. So all of it's quite dovish. It's quite an interesting scenario to be actually sitting here looking at what the statement of monetary policy is saying. It is clearly saying that we still have headwinds around the currency, and that's another part of the statement. We did see a drop off on the release, and you can see on the chart I've got there, it's only a very small one. It's only 20 bips in terms of the movement in the currency. It really is telling you it wants to go to 75 cents for the RBA to happy. However, unfortunately, with all currencies, there's two sides to every side, and the US dollar is the problem here. The US dollar, despite the fact that it should be going up, just can't catch a bid and continues to weaken off and sort of puts the Aussie dollar in limbo and sort of in an area it shouldn't be. The other thing about the statement of monetary policy that really needs to be sort of put out there, they are suggesting that terms of trade is likely to drop off sort of midway through 2018-19 on the back of the fact that Chinese are clearly clamping down on steel production. And that therefore filters into what may have been a positive next year, which is net exports, on the idea that bulks have been quite positive. So the RBA is suggesting that it might actually moderate. So all in all, quite a dovish sort of statement, quite a dovish outlook, and therefore it really does put some slight structural changes into the sort of the economic view from my point of view. You therefore will be probably looking to see a slightly weaker Aussie. It may improve actually in terms of what goes on the equity markets. Those with US denoted earnings may pick up, but in the main, it does suggest that the RBA, not only is it out, it just cannot see a way of normalising policy anytime soon.